Welcome back. There's going to be plenty of things this week to get your teeth into, that's for sure. Tariffs, they're not going to be going away anytime soon, by the way. And in fact, they're going to probably be a hot topic at least going into August the 1st and probably even after that as well. Instead of the world falling off the edge of a cliff like most people thought in April, we have a good chance of booking about $300 billion in tariff revenue by the end of the year. So that's not bad, right? We also get a very important CPI reading. That's the Consumer Price Index. That's an inflation number. We get that tomorrow. It probably won't be enough to move the needle at the Fed for the July meeting, but it could be something for the September meeting, and it might be in play there. Bank earnings, they're also going to be hitting the tape, too. They also will give us a peek into the health of the economy. I'll be watching the loan loss reserves when they come out. That's the money they put aside for loans that they foreclose on, that they lose money on. So the more that they put aside, the more they think things are bad. If they don't have a lot put aside, maybe things aren't so bad. Then I want to keep an eye on crude oil. They surged on Friday. Crude oil prices surged on Friday after Trump said he's going to deliver a major statement on Russia this week, prompting speculation that the U.S. president will agree to sanctions against the major oil producer, trying to get him in line against Ukraine. And finally, Bitcoin. Boy, that's been the talk of the town, hasn't it? It's on the move. It's the world's largest cryptocurrency. It's going to be in the spotlight all week this week, buoyed by optimism over growing institutional adoption at the start of the highly anticipated crypto week in Washington. So that's a lot to get our arms around. So we brought somebody in to please help. Let's bring her on the show, Rebecca Walser, Walser Wealth Management, down in Tampa, Florida. Rebecca, thank you very much for coming on. That's just 3 or 4, maybe 5 things we're looking at. What are you looking at this week? What's kind of top of mind for you?
Well, July is typically bullish, but we do have the options expiration date this coming Friday. So that always means that the institutionals, the hedges, and everybody has to readjust their positions. And Scott, not last week, we don't have the total numbers from last week, but the week before we had over 3.1 billion sold out of ETFs and individual stocks. It was the largest, sixth largest, basically, sale on record, according to Bank of America. And the thing is that who is selling, right? So what you have is you have corporate and retail that are buying, but you have hedges and institutionals that are selling. So we're waiting to see how the volatility picks up. We could have a 5 to 10%, pullback, just with the options rotation. When you look at CPI and PPI, like you mentioned, coming out this week, there is like a 4.7% chance with Fed rate, CME, group weight watch, basically that we could get any kind of cut in July. So pretty much virtually there's no chance, barring some awful economic news that happens this month, that we will get any kind of cut. So you're still looking at higher rates going into August. We won't have a meeting again until September. And so there's no Fed help coming. And so really the market's going to be up to the market. And obviously all the things that you mentioned with cryptocurrency and rotations there's a lot going on, but July is typically bullish. So, we're going to have to be waiting and seeing. But it is important to note that we do have the institutionals and the hedges selling out.
Yeah, I mean, we talk about it all the time, and we had that April 8th low. We saw the carnage a week or two before that April 8th low, when everybody thought that Trump was actually really trying to destroy his own economy. Mr. America First is trying to destroy his own economy, which it's a little bit laughable. However, it was the retail was the one they were the buyers, the pros were the sellers. I think the pros traded their politics. And they're mostly all in New York, and I think that they really got sucked into that idea. But it's going to be interesting to see if this $7 trillion on the sidelines comes back in, because we've had some surety, right, with the big, beautiful bill being passed. We're going to get some of these trade deals done. Where do you stand, by the way, before I get too far down the road, on interest rate cuts? Are you in the we need to cut camp, or are you stand pat camp? What are your thoughts?
It's interesting because Trump obviously coming out saying last week he wants a 300 basis point cut or a 3% cut. I feel like he's just goading Powell. He's just goading him to quit. Just quit while you're ahead, dude, right? Because you're never going to get along with this president, and it's going to be hell for 11 more months here. But, obviously, Scott, I am not on the side of modern monetary theory. I'm not on the side of expansionism. And it's really interesting that you've seen so much volatility and really price, concentration on the 10-year, when we've had no Fed action, right? The 10 years swung wildly this year, and it's because of our debt. And the big, beautiful bill, as much as it's great that we needed a budget and we needed resolution going forward, it is, again, just a massive amount of government spending. And, there was an article in the Wall Street Journal last week that talked about we are at crisis level spending now in the absence of any crisis. Now, I'm not suggesting that, Ukraine, Russia, and the Middle East and all of that isn't going on, but it's like, there's always some kind of war going on. We're perpetually at war globally somewhere, and the United States is somehow involved, usually even if we're not officially involved. We're involved with funding or weapons like we have with Ukraine. And so the bottom line is, yeah, you could always justify this level of spending, but, to the point of DOGE and all the things that Trump really stands for, we are going to have to get back to some level of fiscal responsibility because we are at the point now of the debt spiral beginning. And that's where interest becomes the third or fourth largest expense along with Social Security and Medicare, not sustainable. And when you look at all of the money that we printed in 2020, a lot of that money is getting refinanced. The beginning parts of that stimulus are getting refinanced this quarter, Q3 and Q4 of this year. And frankly, the reason Trump wants 300 basis point cut is because we cannot afford to refinance a Fed funds of 25 basis points at 4.2545. That's the problem. So we cannot afford the debt we're producing at just a 4.25 Fed funds rate. And what does that tell us, Scott?
It tells us a lot. And you know what, Rebecca, I try to talk about it a lot on my show here, but it's a subject that really doesn't resonate. People don't want to know, but they don't want to hear about it. It's the red mist comes down, right? They want to ignore it. And it seems like that happens whenever we send anybody to Congress, too. They say that they want to balance the budget and cut these things there. But when they finally get to Washington, that all goes out the window and they fall in line and they want to spend. So, I mean, I tell you what, the situation is going to solve itself whether they do it themselves or it does it for them. And I'm advocating for them to make the decisions while they still can until Mr. Market makes a decision for them. Because when we all been traders before. When Mr. Market makes a decision and you didn't make the decision, it hurts a lot more, right? 10 seconds due before we go.
Absolutely. A 4.4, 4.5, pushing 4.5, 10 year when we've literally had no changes at the Fed Reserve is indicative of the fact that we might not any longer control the risk being priced into our debt. And that's